duty drawback. So this I have given at the end of the revised book. You can see in page number 479. Page 479, duty drawback. What is, first of all, duty drawback means? Refund. It is nothing but a refund. Whenever you are importing goods and those imported goods are exported, then you will get some refund of customs duty. And what is that refund? What is the purpose of that refund? Simple. You are importing some goods and you have paid the customs duty, so you have a burden of customs duty, but those goods are not really consumed in India. Those goods are exported. So in order to ease out that burden of customs duty on import, they have given this refund, and the name of this refund is duty drawback. But duty drawback is connected to export. Suppose if export itself is not there, then duty drawback will not arise. So there are three cases where there will be duty drawback, and the section 74 and 75 of Customs Act 1962 deals with duty drawback. So imported goods which are exported as such without use. Let's take an example. Say you are importing one robot from Japan for display it in an exhibition, and once the exhibition is over, you're sending the robot back. Imported goods exported as such without use. Then you will get duty drawback under 74 subsection 1. Then second, imported goods exported as such after use. For example, you are importing racing cars for conducting the race here in India, and once the racing is over, you are exporting it back. Imported goods exported as such after use. You are using it here. In the previous case, you are just displaying it in the exhibition. You did not use it. But here, you are using it and then you are exporting. But it is the same car which is imported. Same goods which are imported is being exported. Then duty drawback under 74 subsection 2. Then imported goods which are exported after manufacture or process. Example, you are importing some raw material and you are making finished goods out of that, and once you are making finished goods, you are exporting that finished goods. Okay, so that is imported goods used in manufacture of finished goods which are then exported. Example, smartphones in India, this Xiaomi and Apple, so even other brands like Samsung, etc., and all, they have units in India. So what people are doing, they are importing the integrated circuits, then the panels and the glass, etc., and using that they are making the assembly and they are exporting it. So imported goods which are used in manufacture of finished goods which are then exported. That is 75. Then duty drawback will be under 75. So imported goods exported as such without use, 74 subsection 1. Imported goods exported as such after use, 74 subsection 2. Imported goods which are exported after manufacture, that is 75. Now, input tax credit versus duty drawback. Sir, I have a doubt. Generally, when the imported goods are exported, I am getting duty drawback refund. But on those imported goods, I paid the GST, IGST. Along with customs duty, we pay IGST. Because on import, we pay basic customs duty, social welfare surcharge, anti-dumping duty, etc. And even IGST we pay. Can that IGST paid be taken as credit? Yes. If it is 75. If it is duty drawback under 75, it is possible to take the input tax credit. But if it is duty drawback under 74, you cannot take input tax credit, because duty drawback under 74, they are giving the refund even with respect to IGST paid on import. But duty drawback under 75, they are not going to give you the refund with respect to IGST paid on import. So only the coverage will be basic customs duty and social welfare surcharge. In case of section 74, duty drawback covers IGST and GST compensation cess. And for example, the first example, if you see the robot which is imported and exported, on import, whatever customs duty paid, total customs duty, when you are exporting that robot after exhibition, 98% of the customs duty, total customs duty, you will get as a refund. So which means you will get as a duty drawback. So in that 98% of customs duty, total customs duty, even IGST is also you are getting as relief. That's why in case of 74, duty drawback covers IGST and GST compensations as paid on import. Therefore, ITZ cannot be availed with respect to the same. However, in case of section 75, duty drawback covers only the customs duty but not IGST or GST compensations. Duty drawback is only customs duty, basic customs duty, social welfare surcharge, etc., but not IGST. So ITC can be availed with respect to same, and we can claim refund of that ITC upon export. So in GST there is zero rated supply. Export is zero rated supply. In that zero rated supply we have two options. In that option 2, export without payment of IGST under bond or LUT and get refund of ITC. So that ITC refund you can claim there, but under 75 only. So 74 duty drawback you cannot first of all take ITC. 75 duty drawback you can take ITC with respect to IGST paid on import. That's the difference. Then we are going to discuss now 74 duty drawback first, and then we will see 75 duty drawback. So first section 74 duty drawback. When this section 74 duty drawback is admissible, you are importing goods and those imported goods are exported as such, either without use or after use. If it is without use, subsection 1; if it is after use, subsection 2. And whatever you have imported and what you have exported is easily identifiable to the satisfaction of ACDC, which means that so imported goods and exported goods should be same. There is no change in that. Imported goods are re-exported as it is or after use, and the article is easily identifiable to the satisfaction of ACDC of customs. And what is the time limit within which these goods should be exported? The goods must be exported within 2 years from the date of payment of import duty, plus it can be extended for a further period. But remember, it is 2 years from the date of payment of customs duty on import. Date of payment of customs duty on import, from the date, the 2 years will be counted and it can be extended for a further period also. So here, what is the meaning of date of payment of customs duty? Not the date of import. Also, if the duty is paid on provisional basis, the date of payment of provisional duty is relevant. Whichever date you are paying duty, from that date within 2 years. And they are telling goods must be exported. So here, export goods shall be deemed to be entered for export on the date of issuance of let export order. So while counting this 2 years, you need to count from where to where. From at the time of import, when you paid customs duty, that date, and export you got a let export order, that date. So that difference is what the 2 years we need to count. Then rates of duty drawback. In case of 74.1, when 74.1, imported goods are exported as such without use or after use, without use. 74.1 is without use. Then in that case, 98% of customs duty, 98% of the total import duty paid at the time of importation you will get as duty drawback. So the 2% is the loss. Whereas 74 subsection 2 and duty drawback is there. This is when imported goods exported as such after use. Then in that case, we need to determine the period of usage. Depending upon the period of usage, the duty drawback rate will be notified. So you can see that below this table. Duty drawback rates 74 subsection 2. In case of import of motor vehicles by any person or goods imported by individual for personal purpose, first 2 cases. So what is that? Motor vehicle imported by any person or any goods imported by individual for personal purpose. We have duty drawback under 74 subsection 2. What is that? 100% of customs duty paid on import minus like a depreciation they are giving, minus 4% for every quarter or part thereof in the first year, and 3% for every quarter or part thereof in the second year, and 2.5% for every quarter or part thereof in the third year, and 2% for every quarter or part thereof in the fourth year. Like that we need to reduce. So remember, 4, 3, 2.52. 4, 3, 2.52. First year, second year, third year, fourth year. Okay. So duty drawback is customs duty paid on import minus this. For example, we are using it for first year. First year when we are using it, so we need to take 4% into 4 quarters, that is 16%. So customs duty paid minus 16%. If you are using it for 2 years, so then we need to take first year 4 into 4 16%, second year 3 into 4 12%. So 16 plus 12 28% we need to reduce, and remaining amount we will get as duty drawback. But sir, 2 years is only the time limit now. Here, from the date you paid the customs duty till the date of let export order, only 2 years the goods should have been exported. Then where from 4 years we got, means that can be extended. So plus further extended period by CBIC. So in that extended period, maximum 4 years. So this has to be exported. What if it is exported exactly 4 years, fourth year? Exactly at completion of fourth year you are exporting. Then, so first year 4 into 4 16, then second year 4 into 3 12, and third year 4 into 2.5 10, and fourth year 4 into 2, that is 8, that is 46%. 46% means remaining 54% you will get as duty drawback. After 4 years, nothing. Where such motor vehicles or goods imported for personal use are exported after expiry of 2 years, the duty drawback would be allowed only if CBIC extends. No duty drawback shall be allowed if those goods have been used for more than 2 years. Okay. So if it is not extension, if there is no extension, so then you will not get duty drawback if it is exported after 2 years. So this is when, yeah, in case of motor vehicles imported by a company or any goods imported by an individual for personal purpose. Okay. Import of motor vehicles by any person and goods imported by an individual. So a company importing, yes, individual importing, any person, import of motor vehicles by any person. But goods, other goods should be imported only by individual. Then, in respect of all other imported goods, that is balancing figure, the second branch, what we need to do, depending upon the period of usage, you increase the period for every 3 months. That is 0 to 3 months, 3 months to 6 months, 6 months to 9 months, 9 months to 12 months, 12 months to 15 months, and 15 months to 18 months, beyond 18 months. Okay. So 0 to 3, 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18, and beyond 18. It starts with 95 and up to 75, it gets reduced by 10%. 95, first slab, next 85, next 75. Thereafter, it get reduced by 5%. 70, 65, 60. You got it? Can you remember it like this? 3 months, 0 to 3, 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18, above 18. Above 18, 0. You will not get anything. And it starts with 95. So first 3 slabs, 10%. So 95, next 85, next 75. Thereafter 5%. 70, 65, 60. Got it? So this is the duty drawback rate. Should we remember these rates? Of course, yes. You have to remember these rates because in question they will be giving the period of usage. Depending upon that, you need to determine as to what is that number of days that you have used, months, and how to compute this period of usage. As usual, from the date of payment of customs duty on import till the let export order, that period should be taken. Should we take here quarter as calendar quarter or 3 months as 1 quarter? 3 months should be counted as 1 quarter, not the calendar quarter. Because example, you paid customs duty on 18th March, then 18th March to 18th April, May, June. So 18th June will be counted as 1 quarter, like that. So date to date, the 3 months should be counted as 1 quarter here, not the calendar quarter. This is duty drawback under 74 subsection 2 at the reduced rates. Then mandatory prohibition. In some cases, duty drawback is not possible. What is that? If the amount of duty drawback is less than 50 rupees. So less than 50 rupees, you will not get duty drawback. Even we will also not claim the duty drawback. Okay. So enjoy, gift to you, sir. So therefore we will also not take that. Duty drawback less than 50. Then second point, market price of the exported goods is less than the duty drawback. Why market price of the exported goods is less than duty drawback? Let's take a scenario. You are importing one iPhone. Okay. So practically it happened for me. That's why I'm telling you this. What happened during my marriage? I have purchased one iPhone, iPhone 4, iPhone 4. At that time it was 4, and I gifted it to my wife. And she already comfortable with at that time Sony Ericsson, like that one mobile was there. She was comfortable with that mobile, and she just kept this iPhone 4 because it's the first gift. So therefore she kept it in the almirah. I was of the thinking that she might be using it like that. She did not use it. And after 4 years, while clearing the almirah, I identified that iPhone 4 box piece not at all used. And then by that time, it was iPhone 9, I think. iPhone 9 and all came by that time. And what to do? So I purchased at 55,000 rupees, iPhone 4. I purchased at 55,000 at that time. And I went to the shop to sell it. No, what is the use of it? We can sell it like that. I went to the shop. You know at what price they have purchased it? 5,000. Sir, brand new, sir. Let it be. 5,000 rupees is the price at which they purchased it from me. Okay, they said, we don't need, no one will buy, but it's okay, give. Like that, for 5,000 rupees, they have purchased it. Now, even though you have not used, because of the efflux of time, the market value will come down for electronics. Agreed? So, you imported the goods and you paid the customs duty. You did not use it. You did not use it. You just kept those goods with you, and after some time you exported it. Now, what is the market value at that time? Market value at that time, if you see, that is less than the amount of duty drawback. See the example next page. Value of imported goods is 1 lakh. Customs duty paid on import is 30%, say 30,000. Export as such without use after 18 months. Market value of such goods came down to 20. Possible na? So definitely the market value will come down, and that's why a lot of people will not buy Samsung phones. Samsung and all, initially when they release, high value it will be, and automatically after 6 months the price will drastically come down, and that too after 1 year, 1.5 year and all, half of the rate. So usually they release this S23 Ultra, S24 Ultra, like that. So half of the rate it will come down. So S23 Ultra, I remember they released S24 1,49,999, like that. And when they launched the S25, and because of that big billion day sale, etc., it was available at 75,000 rupees itself. Half of the rate it is available. So definitely it will come down. So like that, the market value of the goods came down to 20,000. Whether duty drawback is available in this case? First, imported goods exported as such without use, what is the duty drawback? 98% of customs duty paid on import. That is 30,000 into 98%, which is 29,400. But the market value is only 20,000, so no duty drawback. Why not duty drawback? Because the market value of the exported goods is less than the amount of duty drawback. So duty drawback will not be given in this case. These are the two restrictions for 74. First restriction, if the duty drawback is less than 50. Second restriction, if the market value of the exported goods is less than the amount of duty drawback. Then look into the next one, discretionary prohibition. So far what we have seen is the mandatory prohibition. Discretionary prohibition is given in 76 subsection 2, which says that if the imported goods are exported and likely to be smuggled back, then they will disallow the duty drawback. For example, we are importing from Germany. Say one missionary we are importing from Germany, and we need to pay, the missionary value is 10 crores. You need to pay 3 crores as the customs duty, say 30%. Now what you are doing, you are importing and you are exporting the missionary. You paid customs duty and you are exporting that missionary. Now out of that 3 crores, 98% you will get as duty drawback. And thereafter, this machinery can be smuggled easily into India through land route. So if that be the case, if they have doubt, then they will disallow the duty drawback. Central government may notify that no duty drawback shall be admissible if any goods which post export are likely to be smuggled back into India. Then identity satisfaction, yes, the importer should prove that whatever imported goods are only exported. Exporter shall establish before proper officer that export are the one which were imported earlier. Then, and here importer and exporter is same person only. Okay. So person who is importing should prove that at the time of import, whatever goods are there, the same are being exported. And what is the interest? Say this. Interest if duty drawback not paid to the claimant within 1 month from the claim date. So I am the person, I am claiming duty drawback. So I need to make an application. When I make an application, within 1 month from the claim date, they need to grant me the duty drawback. Otherwise, they need to pay interest at the rate of 6% per annum from the date on expiry of 1 month till the actual date of payment of duty drawback. For example, I made a claim of duty drawback on 15th of April. So by 15th of May, they should grant duty drawback. Say they granted duty drawback on 6th of June. Then from 15th May to 6th of June, for that period, they need to give me the interest at the rate of 6% per annum on the duty drawback amount. Okay. Sometimes I may claim duty drawback erroneously. Wrongfully, I may claim the duty drawback. Then in that case, I have to pay back the amount along with interest at the rate of 15% per annum. Whenever we pay interest to government, it will be 15% per annum. That 15% per annum will be from the date I got the duty drawback till the date I am paying the duty drawback. If interest if duty drawback erroneously claimed shall be 15% per annum. From which date? From the date of payment of duty drawback, date of payment of duty drawback to the person till the date of recovery of duty drawback. So this is payable by exporter to government. And for 75, there is no separate application for duty drawback. The shipping bill itself will be taken as the application for duty drawback. But for 74, separately we need to lodge the claim. 74, separately we need to make a claim. Application we need to submit. But 75, the shipping bill or bill of export which is filed by the exporter, that itself will be treated as the claim for duty drawback. So this is with respect to section 74. Now we will see 75. 75. When 75 is applicable, imported goods which are used in manufacture of finished goods that are exported. Imported goods used in manufacture of goods which are then exported. Is there any time limit? No. So you can manufacture and export it after 5 years also, 10 years also, 20 years also. There is no time limit. And what is the rate of duty drawback? Here the duty drawback is not based on the customs duty paid on import. It's not a percentage of customs duty paid on import. In case of 74, the duty drawback is 98% of customs duty paid on import or 95% of customs duty paid on import, like that. But in case of 75, the duty drawback is not like that. The duty drawback will be based on rates notified. So there will be a duty drawback schedule that is released by customs department, central government, and in the duty drawback schedule you can find for every product what is the rate of duty drawback. So this is available in CBIC website. So cbic.gov.in. when you visit, you just go to customs, and when you go to customs you can find duty drawback schedule. So this duty drawback schedule, when you see, so there you will be able to identify as to what is the notification, the latest notification, list of goods, like tariff, just like tariff, product, what is the rate of duty drawback, like that it will be given. That is known as all industry rate. Rule 3, all industry rate, and that is generally, and see the third point below in the footnote. As per Rule 4, central government may revise the amount or rates determined under Rule 3. So first they will give a duty drawback schedule depending upon the product. A percentage of FOB value of export will be given as the duty drawback amount. That duty drawback amount can be revised. That means it can be enhanced or it can be reduced. Then Rule 6. What if the product which you are exporting is not available? Okay. So let's see this. So in this customs duty drawback schedule, so duty drawback schedule, so this is the duty drawback schedule they gave. Depending upon the product you are exporting, what is the duty drawback rate? And for live animals they did not give, but meat, so meat exports, so for meat exports they are giving 0.15%. Like that, for different goods they have given different duty drawback. Okay. And in this, if you see, for certain products you may not be able to find the duty drawback. For example, green tea. Green tea, there is no duty drawback given. So 0901, 0902 tea, whether or not flavored, 090201 tea in consumer bags, and others is there given. But green tea specifically not mentioned. So what is the duty drawback in case of green tea? So it is not given. In that case, we can go for brand rate. So all industry rate, if all industry rate is not fixed, when no all industry rate is fixed in the duty drawback schedule, then we can go for brand rate. And for that, they need to make an application. Exporter, see the footnote, exporter shall apply for fixation of brand rate, and until fixation of brand rate, exporter may request for grant of duty drawback on provisional basis. So provisionally you give some money like that, they can request. Till the time exporter gets the brand rate, means they will notify. Till that time, provisionally some amount he can ask. And at the time when it is notified, brand rate is notified in future, either the difference will be payable or receivable. Then look into Rule 7, special brand rate. What is this? You're getting some duty drawback as per all industry rate. That duty drawback as per all industry rate is covering less than 80% of the customs duty paid on import. When duty drawback under all industry rate, fixed under all industry rate, is less than 80% of the actual duty incidence, means whatever actually customs duty paid, not IGST, basic customs duty and other customs duties. So say customs duty paid is 1 lakh and you computed duty drawback, that is 70,000, which means less than 80%. Then you can make a request for special brand rate. But remember, you need to do that homework before. Means you need to do the calculation before, and if you know that you're going to get lesser amount of duty drawback if you go for all industry rate, then apply for special brand rate. It's not like first you will apply for all industry rate, thereafter you will apply for special brand rate. Not possible. Say this: exporter shall apply for fixation of special brand rate. He is not entitled to claim all industry rate, then apply for special brand rate. Till fixation of special brand rate, exporter may request for grant of duty drawback on provisional basis. Got it? Till the fixation of special brand rate, exporter may request for grant of duty drawback on provisional basis. That is with respect to this. And related to that, I gave one question. Say this: illustration on Rule 7, special brand rate, that is in page number 481. A person has imported the goods and the imported value of that goods is 10 lakhs. Basic customs duty 1 lakh, social welfare surcharge 10,000, IGST 1 lakh 33,200. FOB value of export of goods 28 lakhs. So using this import, they have manufactured the goods and they exported the finished goods, that is 28 lakhs. And the duty drawback rate is 3.5% of FOB value of export. Where it will be given, just now I told you na, they will notify the rates like this. So 0.15%, 0.1%, like that they will notify depending upon the product. Sometimes it will be nil also, sometimes it will be 1, sometimes 2.5, like this also they will notify the rates. Depending upon that, 3.5% is the notified rate. So how much you will get duty drawback as per notified rate? 28 lakhs into 3.5%, 98,000. Whether it is going to cover 80% of your customs duty paid, that is 1,10,000. Basic customs duty, social welfare surcharge 1,10,000. So 98,000 divided by 1,10,000 into 100 is 89%. Yes, yes, more than 80%. So therefore, don't make application for special brand rate. So percentage of duty drawback, DBK in short is duty drawback, over the actual tax or duty incidence is 89, which is greater than 80%. So therefore, special brand rate not required. What if duty drawback is 1.5% of FOB value of export? Then 28 lakhs into 1.5%, 42,000. 42,000 divided by 1,10,000 is 38.18%, which is less than 80% of the tax incidence. Therefore, application can be made for special brand rate. However, remember, application for special brand rate cannot be made if the duty drawback is already claimed under all industry rate as per rule 3. Done? So that's what we have discussed in this. So there will be 3 rates: all industry rate, brand rate, and special brand rate. And mandatory prohibition. What is that mandatory prohibition? First point same. Duty drawback less than 50 you will not get. Okay. Second point also same. The market value of the exported goods is less than the duty drawback, then you will not get duty drawback. For example, say this. Value of exported goods in Indian market is 30,000. But you declared a high FOB value, means you inflated the FOB value. So you declared FOB value as 4 lakhs. 4 lakhs into 10% duty drawback, say duty drawback rate is 10%, 4 lakh into 10%, 40,000. But the market value of that goods is only 30,000. So therefore, duty drawback is not allowed. First prohibition, duty drawback less than 50. Second prohibition, market value of the exported goods is less than the amount of duty drawback. Third, the maximum duty drawback is 1/3 of the market value of the exported goods. So this is applicable if the market value of exported goods is more than duty drawback, but the maximum duty drawback is 1/3 of market value. So for example, export price is 1 lakh and Indian market price is 50,000 and all industry rate is 30% of FOB, that is 1 lakh into 30%, 30,000. But maximum duty drawback will be 1/3 of 50,000. What is 1/3 of 50,000? 16,667. So you will get only 16,667 as duty drawback. So whatever duty drawback that is computed, but it is restricted to 1/3 of the market value of that exported goods. Then next prohibition is that if there is a negative value addition. What is negative value addition means? That is, you are comparing FOB value of export and CIF value of import. If your export value is less than the import value, means you are not bringing anything to the country. So when you import, there is a foreign exchange outflow. When you export, there is a foreign exchange inflow. Correct? So no duty drawback allowed if the value of exported goods is less than the value of imported materials used therein. Then suppose if there is a notified rate, for example 10% is notified, then in that case our FOB value of export should be greater than the 10%. No duty drawback allowed if the value of export goods is not more than the notified percentage of the value of imported materials used. Okay, so these are the prohibitions. So duty drawback less than 50%, market price of export goods less than duty drawback, maximum duty drawback is 1/3 of market price, and no duty drawback allowed if the value of export goods is less than the value of imported materials, means negative value addition. No. Suppose if there is a notified percentage, you should achieve that notified percentage. More than that, then only duty drawback is available. Then discretionary prohibition, same. That is, if the goods are likely to be smuggled back, duty drawback is not available. Central government may notify that no duty drawback shall be admissible if any goods which post export are likely to be smuggled back into India. And identity satisfaction, we need to prove to the satisfaction of the officer or not required. Not required. Why? Definitely the goods which are imported and the goods which are exported is different. No, in 75, because in 75 imported goods are used in manufacture of finished goods which are then exported. So exporter shall establish before proper officer that export goods have been manufactured using import duty paid goods. And next, only condition is that he should prove that these goods are manufactured using imported goods. That is enough. We don't have to prove anything else. And this interest point is same. Once we make an application, what is application? Shipping bill is application. Within 1 month, if they are not granting duty drawback, interest at 6%. If we got erroneous duty drawback, we need to pay along with interest at 15% per annum from the date we got duty drawback till the time we pay. These 2 points are same for both 74 and 75. And non-availability of duty drawback. What is this? In few cases under 74 subsection 2. Remember, not 74 subsection 1, 74 subsection 2. So few goods duty drawback is not available. What are they? Wearing apparel. So if you import garments, you use it and then export, you will not get duty drawback. Use it and export, sir? Yes. Example, you might be seeing lot of celebrities will be wearing these imported dresses, imported garments, and the same garment they will not repeat. Do you really think they will buy all these garments and keep it in their wardrobe? No. No, definitely not. That many garments, how they can keep it? So what they do is that there are some companies in India, mostly these production houses, etc. What they do is that they will import the garments and they will pay customs duty on that, and it will be used, and thereafter it will be exported back. It will be used in used by the celebrities, etc. and all, and then it is exported back. And so in that case, whether the customs duty paid on import, they will get duty drawback? No. What if it is imported and it is exported without use, as such without use? Then in that case, they will get duty drawback, because the restriction is only in case of 74 subsection 2, not for 74 1. So if imported goods are exported as such without use, duty drawback is available. So what are those goods here? Wearing apparel, tea chest, exposed cinematograph films, that is the film reel, then unexposed photographic films, papers and plates, and X-ray films. So these 4 goods. So that is about duty drawback under 74 and 75. Now look into the next one. Refund of customs duty paid on import, section 26A. There is one section 26A which will be similar to this duty drawback under 74 subsection 1. Let's see what happens in 26A. Carefully listen. You are importing some goods and those goods became defective. You are importing some goods, those goods became defective, and you are exporting that goods. Now in this case, whatever customs duty you paid on import, 100% you will get refund. So 26A talks about 100% refund of customs duty paid. But 74 subsection 1 talks about 98% of customs duty paid as refund. So what is the difference? Why such a difference? And we need to understand the difference in conditions so that you will know whether it is to be beneficial to go for 26A or 74-1. See that. 74-1, how much is the refund you will get duty drawback? 98% of total customs duty paid on import. But under 26A, how much you will get refund? 100% of total customs duty paid on import you will get as refund. Got it? 74 98% of customs duty paid. Here 26A, 100% of total customs duty paid on import you will get as refund. Situation 74 subsection 1, any case when the imported goods are exported. You are importing some goods and you are exporting it. That's it. 74.1. But 26A is not that. If the imported goods are defective or not conforming to the specifications and then exported. So which means 26A is applicable only for defective goods. But 74 subsection 1 is applicable for all goods. Got it? 74 subsection 1 is applicable for all goods imported which are exported. But 26A is applicable only for defective goods or goods not conforming to specifications. Then instead of export, can we do anything? Still we will get duty drawback? Yes. Please look into 74 subsection 1. Either you export imported goods, you will get duty drawback, or sell it to a foreign going vessel or aircraft. Then also it will be deemed as export and you will get duty drawback, or you sell it to SEZ. Then also it will be deemed as export and you will get duty drawback. So either export or sell it to a foreign going vessel or aircraft, a vessel or aircraft which is leaving from India to outside India, or to SEZ. Whereas 26A, what is the alternative to export? You imported the goods which are defectives, either export or destroy that goods or relinquish the title to such goods. Either you export that goods or you destroy that goods or you relinquish the title to that goods. See that situation. Imported goods are defective or not conforming to specifications and are exported. What's the alternative to export? Either relinquishment of title or destruction of goods. Then what is the time limit within which imported goods should be exported or sold to foreign going vessel or sold to SEZ? In case of 74.1, the time limit is 2 years. We discussed above. 2 years from the date of payment of customs duty, it should be done. So see the time limit to export or alternative to export. 2 years from the date of payment of customs duty on import plus extended time limit by CBIC. But in case of 26A, what is the time limit within which either you should export or destroy or relinquish the title? Within 30 days from the date of import. Within 30 days from the date of import, that is order for clearance for home consumption, and it can be extended for a further period of 3 months by commissioner. So here we have a shorter duration, 30 days plus 3 months. But under 74.1 we have longer duration. And once you completed it, under 74, either you exported or you sold it to foreign going vessel or aircraft or you have sold to SEZ, what is the time limit within which you need to make application? 3 months plus it can be extended for a further period of 3 months by ACDC, that is Assistant or Deputy Commissioner, and it can be extended for a further period of 6 months by Commissioner. But all this time limit is from let export order. Whereas in case of 26A, you have to export it or destroy it or relinquish the title. What is the time limit within which you need to make application? Within 6 months from let export order or relinquishment or destruction. 6 months, only one time limit. And is it applicable for perishable goods? 74 subsection 1 is applicable for perishable goods, but 26A is not applicable for perishable goods. And what is the time limit to grant refund? In case of 74.1, 1 month from the date of application. So whenever you make application from that date, within 1 month they need to grant refund, otherwise interest will be at the rate of 6% per annum. Whereas 26A, what is the time limit within which they need to grant refund? Usually refund time limit is 3 months. 3 months. So therefore when you make application, within 3 months they need to grant refund, otherwise they will pay 6% per annum. So here 1 month, there 3 months. So these are the differences between 26A and 74 subsection 1. Okay. And look into next page. Sometimes if you are getting more benefit, more than the customs duty paid, the duty drawback rate can be reduced. So see this example. You are importing and the customs duty is 12%, so 12,000. Social welfare surcharge 10%, that is 1,200. And IGST say 18%. IGST is 18%. So therefore we have 20,376. And domestically also you made a procurement 50,000, GST 18%. Now you exported the finished goods, the value of the finished goods is 3 lakhs, and the duty drawback is 7.5% of FOB. Means how much you will get benefit? 3 lakh into 7.5%. So you will get 22,500. Sir, first you will be getting 22,500 as duty drawback plus GST paid, you can take ITC. So this IGST 20,376 plus 50,000 into 18%, that is 9,000. So this 29,376 you can take ITC refund under GST. So which means how much benefit you are getting? 29,376 plus 22,500, you are getting 51,876 as benefit. But what is the total customs duty you paid? That is only 12,000 plus 1,200 plus 20,376 plus 9,000, only 42,576 is your total tax incidence. In that case, this 7.5% of duty drawback rate is there na, that can be reduced. So duty drawback rate of 7.5% may be reduced. Okay, that power is there under rule 4. So this is about duty drawback that you have. Let's see some questions related to this. You please look into page number 410, page number 410 of practice manual, CMA practice manual. You see that page number 410, question number 1. X Limited exported following goods to USA. Discuss whether any duty drawback is admissible under section 75. So they are asking about 75 here. They are asking about 75. FOB value of the exported goods is 2,50,000. Market price is 1,80,000. Duty drawback rate is 30% of FOB. Now, how much duty drawback? 30% of FOB, please do the calculation. 2,50,000 into 30%. 2,50,000 into 30% is 75,000. But what is the maximum duty drawback? 1/3 of market value. So market price 1,80,000 divided by 3, 60,000. So even though 75,000 is the duty drawback as per the rate, but the maximum duty drawback is only 60,000. So 60,000 is only allowed as duty drawback here. Next, second, FOB value of export goods is 1 lakh and the market price of the goods is 50,000 and duty drawback is 0.75%. So see, usually duty drawback is computed on FOB value of export. So 1 lakh into 0.75%, that is 750. So definitely we will get duty drawback. There is no issue. And if it is less than 50 only, we will not get duty drawback and no other restriction. The market value is more than the duty drawback. So we will get duty drawback in this case. That's not a problem. Next, C, 8 lakhs is the export value. Market price of the goods 8,50,000. Duty drawback 3.5%. So 8 lakhs into 3.5%, that is 28,000. 28,000. But if you observe, for product C, one note is given. Import value of product C is 9,50,000. No duty drawback. Why? One condition we discussed. The export value should be more than import value. If export value is less than import value, you will not get duty drawback. So in case of product C, there is no duty drawback. Since the value of export is less than the value of import, that is negative sale. So no duty drawback. Then D, FOB value of export is 2,000. Market price of the goods is 2,100. Duty drawback rate 1.5% of FOB. So 2,000 into 1.5% is 30, but less than 50 rupees you will not get duty drawback. So no duty drawback because it is less than 50. That's why. Okay. Next. So this is how you may get a question. related to 75. Next question you see, calculate the amount of duty drawback allowable under section 74 of Customs Act 1962 in the following cases. 74 year, 74. Suresh imported a car for his personal purpose and paid 5 lakhs as import duty. The car is re-exported after 6 months. Now what should be taken in this case? It is imported goods exported after use. It is imported goods exported after use. So therefore, we need to take 74 subsection 2. 74 subsection 2, two branches are there. First branch we need to take. What is that first branch? Car imported by any person or other goods imported by individual for personal purpose. This is car. Definitely for this car, we will be getting that model, first branch. What is that? Depending upon the period of use, we need to reduce the depreciation. 6 months means how many quarters? 2 quarters. 2 quarters. So therefore 4% for every quarter or part thereof. So you reduce. So 5 lakhs, 5 lakhs minus 8%. 5 lakhs minus 8%, 4 lakh duty drawback. 1 second. 4% per 6 months. 6 months means 2 quarters na. So 2 quarters, correct? Suresh imported car and re-exported after 6 months. For every quarter or part thereof in the first year, it will be 4%. So 4 plus 4, 8. So 8 means 20 days we missed and 20 days. So that is 1 quarter. 6 months, okay, and 20 days, 1 quarter. So 3 quarters. 3 into 4, 12%. You check this here, we discussed na. So this branch. So 4% for every quarter or part thereof for the first year. So part thereof. So here we used it for few days, 6 months and 20 days. So you count it as 3 quarters. 3 quarters means 12%. So 12% we need to reduce. So 5 lakhs minus 12%, that will be 4 lakh 40,000 will be the duty drawback. Second, Nikita imported wearing apparel and paid 50,000 as import duty as she did not like the apparel. These are re-exported after 20 days. No duty drawback. Why? We discussed 74 subsection 2. 74 subsection 2 duty drawback is not available in case of wearing apparel. So therefore in this case, she is exporting it after use. That's why duty drawback is not available. Third, High-Tech Limited imported 10 computer system paying customs duty of 50 lakh. Due to some technical problems, the computer systems were returned to foreign supplier after 2 months without using them at all. Without using them at all, it is exported. Imported goods exported after use or without use. Without use. How much duty drawback? 98% of customs duty paid. So total customs duty 50 lakhs, 50 lakhs into 98%. Since these goods are re-exported without use, so we will get this amount as duty drawback. Then question number 3, an exporter exported 2000 pairs of leather shoes at 750 per pair. All industry rate of duty drawback is fixed on average basis, that is 11% of FOB, subject to maximum 80 rupees per pair. The exporter found that the exporter found that the actual duty paid on inputs was 1,95,000. He has approached you as a consultant to apply under Rule 7. To apply under Rule 7. So what is that Rule 7? Fixation of special brand rate. First, what is the duty drawback? Duty drawback as per all industry rate. Please see. 11% of FOB. Please do the calculation. 2000 into 750 into 11%. That is 1,65,000. 1,65,000 or maximum 80 rupees per pair. So 2000 into 80. So that will be 1,60,000. Whichever is less. So the duty drawback is 1,60,000. 1 lakh 60 divided by, so when you can go for special brand rate, if the duty drawback as per all industry rate is less than 80% of the tax incidents or duty incidents, you can go for special brand rate. Now how much is the customs duty? The exporter found that the actual duty paid on inputs was 1,95,000. So 1,60,000 divided by 1,95,000 is 82.05%, which is more than or equals to 80%. So can they go for special brand rate? No. Exporter is not eligible to apply for special brand rate. So they can claim only all industry rate. And when they can go for special brand rate? Only when all industry rate does not cover 80% of the duties paid by the exporter. Then question number 4, ABC Limited, who is an exporter, finds that amount of duty drawback refunded to it is less than what it is entitled to on the basis of the rates of duty drawback announced by the central government. Briefly discuss whether ABC Limited can claim the difference of duty drawback short refunded and the procedure to be followed in this regard. See, in this case, they need to go for refund. ABC is eligible for claiming the difference of the duty drawback on the basis of amount of rate of duty drawback, and they have to do it within a period of 3 months. And this 3 months can be extended for a further period of 9 months for filing a supplementary claim with the accompanied fee of 1% of FOB of exports or 1000, whichever is less. So it can be. So they have to pay that fees for extension. Normal time limit 3 months. And it can be extended for a further period of 6 months. First extension is 9 months. Thereafter extension is 6 months with a fees of 2% of FOB or 2000, whichever is less. So it's a theory question. This can be asked like this. Then next, calculate the amount of duty drawback allowable under section 74 of Customs Act 1962 in the following cases. Salman imported a motor car for his personal use and paid 5 lakhs as import duty. The car is re-exported after 6 months and 20 days. Already we discussed this. So it is car imported by any person. So 4% for every quarter or part thereof. 6 months and 20 days means 3 quarters. And then that is 12% we need to reduce. So 88% we can claim duty drawback. Correct? Then B also same, C also same. It's just a repetition. Same as that question, what we have seen. Same as question number 2. Same as question number 2 above. Okay. Then question number 6. With reference to duty drawback on re-export of duty paid on imported goods under section 74 of Customs Act, answer in brief the following questions. What is the time limit for re-exportation of goods as such? What's the time limit here? 2 years na? 74. Under 74 the time limit given is 2 years. And that 2 years from the date of payment of customs duty. Okay, 2 years from the date of customs duty. And let export order, the date should be taken. What is the rate of duty drawback if the goods are exported without use? If the goods are exported without use, 98%. And is duty drawback allowed on re-export of wearing apparel without use? Yes. Wearing apparel without use? Yes, possible. Okay. Next, Abdul Overseas Private Limited was erroneously refunded a sum of 30,000 in excess of actual duty drawback on 16/6/2017, and a demand for recovery of the same was issued by the department on 24/8/2017. And Abdul Overseas Private Limited returned the erroneous refund to the department on 1610. So therefore, what should be taken as the interest? See, in case of erroneous refund, interest should be computed at the rate of 15% from the date we got the refund. When we got the refund? So 16/6/2017, and when the refund is paid 16/10. So see the number of days. In June, you take out 30 minus 16, 14 days in June, and July 31 days, August 31 days, September 30 days, and October 16 days. That is 122 days. Don't count 16/6 pa. Don't count 16/6. Actually, it should be 122 days. So 30,000 into 15% into 122 divided by 365, that is 1,504. 1,504 rupees will be taken as the interest. Next, A exported a consignment under duty drawback claim consisting of the following items: 200 pieces of pressure stores, mainly made of beans, at pressure stoves, it is pressure stoves, and made up of brass. 200 pieces of pressure stoves, mainly made up of brass, at 80 rupees per piece, and FOB value 16,000. Duty drawback rate is 4% of FOB. So 4% of FOB means 16,000 into 4%, that is 640 rupees you will get as duty drawback. Then 200 kgs of brass utensils, 200 kgs of brass utensils at 200 rupees per kg, 40,000, and say this 24 rupees per kg and 17.5% of FOB. So 24 rupees per kg directly given, so you take that. So how many kgs? 200 into 74, that will be 14,000. 200 kgs of brass utensils at 200 rupees per kg, 24 rupees per kg is given. So therefore we will take 200 into 24, 14,800. So the answer is 14,800. So first one is this is second, and next third. 200 kg artware of brass at 300 per kg, 60,000. So what should be taken as the duty drawback? 17.5% of FOB subject to maximum 38. On examination, weight of brass artware is 190 kg. So only on 190 kgs we will get duty drawback. So first 60,000 into 17.5%. 16,000 into 17.5%, 10,500. 60,000 into 17.5%. But sir, 60,000 is for how many kgs? 200. But only 190 kgs is exported na. Then proportionately you change. 60,000 divided by 200 into 190. That will be 57,000. 57,000 into 17.5%, 9,975. Or 190 kgs into 38, that will be 7,220, whichever is less. So 7,220 will be taken. Okay, so this will be, so this is 4,800 only, na? 4,800, because 24 rupees per kg into 200 kg is 4,800. So total 12,660. Next, question number 9. This is repeated question. Yes, pa. Yes, pa. Clearly it is given duty drawback is 17.5% of FOB subject to maximum 38 rupees per kg. So we need to take FOB, but the problem is that even though they have showed 200 kgs as export, but on examination they came to know only 190 kgs is exported. Then only on exported quantity we will get duty drawback. So 60,000 divided by 200 is total into 190 kgs, that will be 57,000. That 57,000 into 17.5% will be 9,975. This is 17.5% of FOB. Then or 38 rupees per kg. How many kgs? 190 kgs into 38. That will be 7,220. Whichever is less, because subject to maximum is the word used. So whichever is less is 7,220 should be taken. Next. See, this question number 9 is repeated already. We discussed this above. Then look into question number 10. Question number 10. Calculate the amount of duty drawback allowable under the Customs Act in the following cases. First one, A. Jaggi Mehta imported a car from UK for his personal use and paid 4,50,000 as import duty. However, the car is re-exported immediately without bringing it into use. Super. 98%. 4,50,000 into 98%, 4,41,000 they will get duty drawback. B. Meenakshi imported a music player from Dubai and paid 12,000 as import duty. She used it for 4 months and then re-exported. Then any goods imported by individual for personal purpose. Is it personal purpose or not? Not given. Not given. It's not given as personal purpose. Only when it is given as for personal purpose, this first slab we will be taking, this first branch we will be taking. But it is not given as personal purpose, so we need to apply the second branch. In the second branch, depending upon the period of usage, 4 months means it comes under 3 to 6 months. 4 months means it comes under 3 to 6 months. So how much is the duty drawback? 85%. So 85% of 12,000 will be the duty drawback. Next, C. XYZ Limited exported 1,000 kgs of metal of FOB value 1 lakh. Rate of duty drawback on such export is 60. Market price of the goods is 40. Now do the calculation. So how much is the duty drawback? 60 rupees per kg. 1,000 into 60, 60,000. But the market value is only 40,000. So no duty drawback. Why no duty drawback? XYZ Limited is not entitled to claim duty drawback since the market value of the exported goods is less than the amount of duty drawback. Next. Question number 11. Messrs. Delta Exports Limited exported goods with FOB value 10 lakhs on 10 January 2024 and claimed duty drawback of 40,000. The claim was filed on 15 January 2024 but was not processed within 1 month. The department credited the duty drawback on 5th March. Calculate the interest payable. So within 1 month they need to sanction the duty drawback, correct? Within 1 month. So we are making claim on 15 January. Then they need to give it by 15th February. But they are not giving, they are giving it on 5th March. So therefore in February, 29 minus 15, 29 days. So that is 14 days in February and 5 days in March. So 19 days. For that 19 days we need to get interest. What is the duty drawback? 40,000 into 6% into 9 by 366. That is 124.59. So 125 rupees we will get as interest. Then question number 12. Messrs. Gamma Textiles Limited claimed a duty drawback of 50,000 on 5th May 2024. It was later discovered that the export proceeds were not realized within the FEMA stipulated time limit. Say demand was raised on 10th November and the recovery was made on 25th January 2025. So interest will be payable from the date of giving duty drawback till the date we are paying it back. So 5th May to 25th January. In May, 31 minus 5, that is 26 days in May. June 30 days, July 31 days, August 31 days, September 30, October 31, November 30, December 31, January 25. That is 265 days. So 50,000 into 15% into 265 by 365. So this 5,445 will be the interest. Then next, measures Sigma traders exported goods to Nepal, nearby countries with FOB value 2 lakhs and claimed duty drawback 8,000. The export proceeds were realized in Indian rupees. Determine whether the duty drawback is admissible. So no, definitely the payment should be realized in foreign exchange. If the payment is realized in Indian rupees, it is not allowed. Only in GST it is allowed. Only in GST the exports can be to Nepal and Bhutan, the consideration can be Indian rupees, not for customs. Duty drawback not available. So duty drawback not eligible if the consideration is not realized in foreign exchange. Then question number 14, measures Theta exports claimed a duty drawback of 400 on FOB value of 60,000, that is 0.67% of FOB. Is the claim admissible? So therefore see this here, but this point is omitted now. This is not there. This is not there. It is omitted. It is not there. You just strike off. Previously we had, if the duty drawback rate is less than 1%, you will not get duty drawback like that. But that is now omitted. We don't have. Then question number 15, measures Epsilon Enterprises exported goods with FOB value 12 lakhs on 1st March and claimed duty drawback of 60,000, and this department created the duty drawback on 20th April, compute the interest. Again same, when they got the duty drawback 1st March and they made a claim on 1st March, but they are getting the credit on 20th April. So 1st March to 1 month, 1st April. So 1st April they should have got, but they are getting it on 20th April. So you count the interest. So what is that interest? Interest will be 19 days. How 19 days? Don't count 1st April. You count 20th April. So 19 days, interest will be at the rate of 6% per annum. Then look into question number 16. Measures Rohan Footwear Private Limited exported 2,000 pairs of leather shoes at FOB value of 750 per pair. The all industry rate of duty drawback is fixed on an average base at 11% of FOB, subject to maximum 80 per pair. Means how much duty drawback they will get? 2,000 into 750 into 11%, 1,65,000. But the actual duty paid 1,95,000. Already we discussed. Already we discussed this question above. This is same, that 82.05. So no duty drawback. Repeated. This is a repeated question. Even question number 17 is repeated. Already we discussed. And question number 18 also repeated, Jaggi Mehta with names. We discussed that. And say this, question number 19. Question number 19, measures Vertex Solutions Private Limited imported certain electronic equipment for commercial use. The following details are available for claiming duty drawback under section 74. Import duty paid 16,50,000. The goods were used and remained out of customs control for 13 months before re-export. For company using it and selling. So we need to see the period. What is the period? 13 months. 13 months means it will be coming under 12 to 15. So 12 to 15, what is the duty drawback? 65%. So 65% of the customs duty paid we will get as duty drawback. Okay. So that is about this, and the remaining are some repeated questions. You can try that. You can do now these questions. Just repeat it only, whatever concepts we discussed. So with this we completed duty drawback.